Welcome to FinAc Plus Finishing School. We bridge the gap between academic concepts and real-world application across accounting, banking, corporate finance, capital markets, risk, ESG, and more. In each video, we explain not just what financial terms mean, but how they work in real business environments. Today's topic: share capital reserves and surplus.
Hi, this is Prabhakar. In last session, we talked about balance sheet at high level. Now we will take item by item and then talk about individual items and then how to understand and analyze those topics. But I am not taking entire balance sheet now, but I am taking shareholder capital and reserves. To understand it better, I am comparing with current assets. Because shareholder capital and reserves increasing alone will not reflect the value of the company or the growth percentage of the company. That is why I took the inventory, debtors, and then cash balances as to compare whether that shareholder capital and then the reserves increase actually reflecting in the real assets or not. So when you see the numbers on the board, shareholder capital is the original capital investment made by shareholders, and then reserves are the accumulated profits. So shareholders started with their company with 1 crore, but every time they will not increase the capital, but they will, whatever profits they are earning will come and sit in the reserves line item. So here, if you see, the 1 crore is actually remaining 1 crore, but 1 crore in reserves actually became 8 crores in the reserves. That shows a very good number. 1 crore became 8 crores. That means a kind of 700% increase. 1 crore is actually becoming 700% increase. And if you see the year-on-year increase also 100%, 115, 33. So actually good, strong growth percentage is there, and then overall 283.3% grown when you total all these things. But if you compare with 1 year to 5 year, it is 700%. But there is another thing, okay, whatever in a balance sheet, all liabilities are actually credit balances and assets are debit balances. So whatever money actually as a sources of funds you have either in share capital or reserves should reflect in the assets. Then with what kind of assets it is getting generated is important. So I didn't take the entire fixed assets and all entire balance sheet, but because the reserves actually directly get into these current assets, and then basically it should get realized into cash and bank balances. But if you see the example here, it actually, you see the lot of growth here in inventory and debtors. So even though the percentage of growth is heavy when you compare year 1 to year 5 and also year on year, but it is not getting realized in cash. The cash balances are not increasing. In opposite, the debtors balances are increasing. Then this is giving us a doubt. So I'm not telling this is final, but whenever you see the balance sheet, you need to compare this number with that number and then liabilities to assets. I'm trying to teach how to compare. So when you see then immediately when debtors are increasing, you also need to see the average sales for these 5 years. So average sales for 5 years, let us say it is 5 crore, and average debtors for these 5 years is 4.4 crores. Generally, sales should be very in the multiples of debtors. But here if you see, debtors are actually only 4.4, and then where the sales, average sales are 5 crores. This is also giving another doubt. And inventory is also 2 crores are there. So whether this company is really doing good work or not, good growth or not, you need to see other percentages and other numbers, and then you need to go in detail into the invoice, the income statement, profit and loss account statement, and understand whether every the sales how they are getting converted into cash. And you also need to compare with the cash flow statement, how much cash is generated from operations to understand it better. So looking at the balance sheet is not you cannot blindly, isolately, you cannot see only this numbers and then feel this is a great company. Sometimes this kind of window dressing and malpractices can happen in the balance sheet. But okay, the audited balance sheets will have the qualified chartered accountant signing on the balance sheets. But still, as a person who is investing, you need to use your own calculations to understand what is the real growth of the company. So thank you very much.
Thank you for learning with Finac Plus Finishing School. We hope this session gave you practical insights into real-world finance. Our goal is to help you build industry-ready knowledge for stronger career growth. If you found this helpful, please like, subscribe, and share. Let us know what topics you'd like us to cover next. See you in the next session.